You're listening to The Whole Truth, a Resources Rising Stars podcast.
Welcome to the final episode of the Whole Truth podcast for 2025. We've ended the year on a very high note here, talking to Alex Dorsch. He's the Managing Director of Chalice. Chalice owns the Gonneville project in Western Australia. It will produce a basket of metals, but most notably one of them is palladium. A lot of this discussion centres on palladium. The price has had a very strong run and it looks like it's set for further gains, basically because the world is coming to realise that EVs are not going to take over the world as nearly as rapidly as previously thought. Palladium is a key ingredient in the hybrid engine model and petrol engines. So the palladium price took a bit of a knock when the world took a view that EVs were going to take over. There's been a big realisation in the last 6 months, of course, that in fact petrol and hybrid cars have got a very strong future. That's seen the palladium price run and it's taken Chalice with it. Chalice shares have doubled this year and the company looks set for further gains on the back of this trend towards hybrid vehicles. Alex takes us through why hybrids are so good news for the palladium price and how leveraged Chalice and Gonneville is to further gains in the palladium price. The long and the short of this discussion is, if you think that the world is going to keep buying hybrids and petrol cars, then you're going to like Chalice. Alex, to twist a great line from Charles Dickens, it was the worst of times. It's fast becoming the best of times at Chalice. Obviously, still some more work to be done, but you've had a cracking year.
Yeah, thanks, Paul. Good to be with you. It has been a cracking year after 2 very, very difficult years. We sort of went through a trough in the cycle for PGMs and nickel at the same time, 2023, 24. And now, as you said, the trend is our friend again. PGMs have really started to lift off the lows. It's been a fantastic year, commodity price wise. That looks like it's going to continue, and obviously we've done amazing work on our project as well. So
now let's look at the worst of times, as Dickens would say. I mean, we had you in this studio in August 2023. You just put out the scoping study on the Gonneville project, and you're getting castigated far and wide. One of the things that you were getting speared over was the assumed prices that you had put into that study. Nominally the palladium price, I think you had nominated a price of what, 1,300, of nearly 2,000 US dollars an ounce. And people said it's unrealistic, you'll never get $2,000 an ounce, and therefore the study doesn't really add up. But funnily enough, the palladium price today is what? $1,750 going on to $1,800. You must sort of wonder whether you should have listened to them and just stayed the course.
Yeah, the context there is, when we found this deposit in 2020, the price was about 2,500, and then we spent sort of 3 years sort of fluctuating between 2,000 and 3,400. So it was pretty geopolitically charged, the metal. Palladium, it's a Russian metal. Russia produces 40% of the world's output, and it was volatile. So we unfortunately, I guess, went and designed the project at a heightened price environment. We also designed the project with a more downstream type, flow sheet, and then sort of over the course of 2023, the prices really started to dive all the way down from 3,400 to about 900 US an ounce. So we were sort of caught between not having quite the right flow sheet, not having the right metallurgy, but also on the wrong side of the trend.
So you put that scoping study out, you priced in US $2,000 an ounce, you got fairly monstered. As I say, people said that's not realistic. So you went back to the drawing board, and this is where the game really started to change for Chalice, wasn't it? You went back to the drawing board, but as I said, going from the worst of times to the best of times, earlier this year you announced a big metallurgical breakthrough that was a game changer for the project.
Yeah, that's right. I guess the benefit was all the metal was still in the ground, even though we copped a bit of a whack on the trough of the cycle. And the original scoping study. As you said, we went right back to square one, and we said for the first sort of 2 or 3 years, we couldn't make the flow sheet generate saleable nickel concentrate. We could generate a saleable copper concentrate very, very easily. We were sort of not having much luck getting the nickel concentrate up to a saleable nickel content. Then late last year, early 25, we started to really understand what reagents and what grind size, what parameters in the float cell would generate that at plus 8% nickel con, which is sort of the saleable threshold's about 6%.
Now the key implication of this is that it meant that you actually cut off a chunk of the processing route, didn't you? That the last few stages, which means that you're just going to sell a concentrate rather than a more developed, more processed product. And by ending your processing route sooner, in simple terms, you therefore obviously save a whole lot of capex.
Yeah, that's right. We were effectively building two plants in the scoping study. We were building a float plant, a leach plant, and this big hydromet facility to process the nickel concentrate. So we've dropped the hydromet facility. So in the pre-feasibility study that came out last week, about $300 million Australian is gone because we're not doing that hydrometallurgical process anymore. We've still got the float plant, the leach plant, but we just don't have that level of processing anymore on the nickel side.
So it's a simpler, shorter processing route.
Absolutely. Fundamentally simpler. It's like what everyone else does. If you've got a gold copper operation like a Boddington or a Telfer or Acadia, they float into a copper con, and then they leach the float tails and get whatever remaining gold comes out of what wasn't captured into the float.
So you cut, by that metallurgical breakthrough means that you cut a whole lot of capex out of it, you reduce the cost of the project, made it simpler, but of course in the process, or against the background of rising prices, particularly palladium.
That's right.
So when you've put out the PFS, you now have priced in what? What's your assumed price there?
So we've taken a more realistic view of the macro. I guess we did all our design optimizations really at the bottom of the cycle. So that was about $1,000 an ounce palladium, about 16,000 nickel, and about 8,500 copper. So we've used those prices to sort of make sure the project works.
So this is important because, so for our listeners, because they would say, right, the prices you're now assuming in the PFS that you've just put out are actually lower than spot.
Oh, much lower than spot now. So
you've returned the whole thing upside down. You had a price assumption in the scoping study that was higher than spot.
Yeah.
Hence you got monstered. You've now got to assume prices are much lower than spot. So you've been very conservative.
Yeah, I think we have had that feedback that certainly on the PGMs we've been much more conservative. But we have just lived through 2.5 years where the price trundled between sort of 900 and 1100. So we wanted to make sure that the project was absolutely rock solid, even at the trough of the cycle. We think prices are going much higher, mind you, than 1300. So that's why we presented it sort of at spot, and we gave obviously a range of, we gave a table which shows you,
as we said at the outset, what's 1750 today.
Exactly. So that's the benefit of our project now with this simple flow sheet, with those big capital bits of plant taken out. We can sit there and be profitable. We can get this project going at the bottom of the cycle, and it starts to look incredibly compelling towards the top of the cycle. We don't think we're at the top of the cycle yet.
Yeah, sure.
Last time prices went 3,000 plus. We've just gone, they've just gone through $1,700 an ounce. So yeah, we think given the inelasticity, there's no other projects that can come online to satisfy demand. So when the market is short, prices typically explode very, very rapidly higher. So that's what we're seeing at the moment.
So you've combined, you've now got a better price environment, and you've got a much lower capex and a simpler project. Now you put all that into the PFS, and what does the PFS show Gonneville will look like now?
Yeah, so it looks like a 23-year open cut operation, not far outside of Perth, and it's going to generate about $4.7 billion of cash flows over that 23 years. And we'll have mined about half of the existing resource.
So what's the internal rate of return? That's what I suppose the key figure here.
So on our base case, it's 23. Base case prices 23%. At spot prices now, sort of low 30s, around about 31, 32%.
Yeah, so it's really getting up there.
Obviously, spot prices are moving higher, as we said, rapidly. MPV on a pre-tax basis, 1.4 billion at our base case. Now something like 2.3 billion at spot prices as we speak here today. So we think it is looking very, very compelling, but it still looks compelling at that base case environment. So we don't need higher prices to get the project incentivized and funded. we're in a position where, we've got a great project in all price environments.
Right. Now, we've been talking about the price, so let's have a look at why is the palladium price so much stronger and what's driving it. There's a lot of things happening in the world. I think it's probably worth recapping for the benefit of our listeners, Alex, that palladium is a key ingredient, if you like, in catalytic converters in petrol engines. Absolutely. So a lot of the fall in the palladium price that you was referring to was being blamed on the shift or the expected shift from petrol cars to EVs. Now, we all know that over the past year, things have moved quickly, haven't they? How the world is seeing the EV outlook so differently. This week, we've had some big announcements from Ford, speculation out of Europe. Take us through what's happened to that market and why it's driving the palladium price.
Yeah, so the palladium price was fairly geopolitically charged in the 2021-22 period. When Russia invaded Ukraine, there was talk of Russia being cut off from markets. That sort of put a lot of anxiety into the auto sector about where they were going to get their catalysts and their palladium from. But then, as sort of the Ukraine invasion stagnated, and there was sort of no resolve, no resolution there. The price, I guess, the auto sector, we think, started to destock and started to lose that anxiety over supply. And then that was also coupled with what we think Russia was basically dumping in the market. And that you'd expect that, right? If Russia has a war machine to fund on their western flank, they're going to be selling anything of value that they have in their inventory or their strategic reserves to fund that war machine. So prices were dumped all the way down from 3,000 to 900 US an ounce. And then that was matched by this sentiment, as you said, about everyone's going to electrify. Every new car is going to be a battery electric vehicle. And whilst that has been the case, we currently only have about 14% of new car sales globally being fully electric. What we have seen, though, is customers really preferencing a transition technology, and that is hybrids.
And that's the game changer for the palladium price, isn't it? The hybrid solution.
Absolutely, because hybrids actually use more palladium in their catalytic converter because you're dealing with stop-start conditions. So you've got a higher loading or higher amount of palladium per vehicle now, which has actually kept palladium demand
right than in a standard petrol engine.
Absolutely, and so demand has been kept flat, while supply has just fallen off a cliff. So you've seen no investment into palladium supply in Russia or South Africa, the two key producing countries. So, and then just in the last week, I think one of the most, I guess, predictable but consequential announcements that we'd been anticipating is that Europe has walked back from its internal combustion ban of 2035. So they were intending to insist that all their car makers, go to 100% electric by 2035. They've just said that's not realistic. So it doesn't take much shift in that electric vehicle adoption curve to really swing the palladium market by hundreds of thousands of ounces. And it's only a sort of a 9 million ounce a year market. So small little perturbations, big change in sentiment and big sort of deficit conditions now, and we've seen prices really explode in the last 7 or 8 months, off that low.
The Ford announcement this week was very telling in terms of the market outlook for Chalice.
Absolutely. So yeah, we had two. We had the Ford announcement and that Europe or EU announcement. I guess it marks a sentiment shift, we think. So there's been this sort of negative sentiment long term around palladium because of battery electric vehicles. And that has sort of pushed the market consensus sort of prices.
I mean, Ford's taken a massive write-off.
Absolutely.
And made no bones about it. They've completely changed strategy.
Yeah, they're not the only ones as well. Stellantis, Porsche, BMW, Toyota. Obviously, Toyota sort of invented the hybrid vehicle. You've seen these companies sort of come back to realism. They thought they could immediately sort of transition all their factories from 100% internal combustion to 100% battery electric vehicles. They clearly haven't been able to do that, and they haven't been able to compete with China. So China, the reason why sort of battery electric vehicles in China are so cheap is because there's subsidies. Effectively, China provides zero cost finance and subsidies all the way through the value chain to drive the other competitors out of the market. So really, we've seen sort of realism come back from the US, European and Japanese car makers saying, we can't force people to buy fully electric vehicles. They're going to progressively move to electric over the long term, but consumers want that flexibility.
That's effectively what Ford said. We've read the market wrong, and with obviously with Trump winding back a lot of these EV so-called incentives and financial incentives and the like in the US, Ford has said we've got it wrong. We've got to get back into the petrol game.
Absolutely, and I think if oil prices are $60 a barrel, electricity prices are skyrocketing globally. In almost every single jurisdiction. So you've got a disincentive to move to electrons when oil remains cheap. That's the other thing. So I think, we can see hybrids being the transition technology here for 20 plus years, and we've got a 23 plus year mine life. So we think we're in for a very, very good macro environment here for the next few years.
So back to Gonneville then. What happens next? You put the PFS out. Things are looking pretty good. You got the capex down. The forecast returns are good. The price environment looks like it's going your way. What do you do next?
So really, it's about three things at the moment. There's a funding strategy being put together. There's a lot of critical minerals funding out there from Western governments looking to lend extraordinary amounts of money to projects like ours. So we're sort of building those relationships with those sovereign sources. We're talking to a range of strategic sort of players in the nickel copper space, but also in the PGM space. This is such a unique asset. There's no one else really has a palladium project that's of this scale and as advanced as this. And it's obviously in a great mining jurisdiction. So we're getting lots of inbounds, in terms of companies looking to partner with us or help us take this to the next step. We're about halfway through our approvals process, so we've got to get through the regulatory approvals. We've got the highest level of endorsement from state and Commonwealth at the moment on the project. So they recognise, as we do, there's a pathway to get the project approved, and it is a process to go through. And we've bought the farmland already, which really de-risks that approvals process. It is our land. We're going to put infrastructure on. We're going to put the mine and the process plant and the tailings dam on. And then the third part, I guess we've now got some optimizations to do, and we're working on that in the background. We've showed what the project looks like in the bottom of the cycle, sort of optimized for that very, very bear case environment. We're going to sort of really have a look at now. Is there some improvements to make? If we sort of bring everything up to that 1,300 palladium level. And really that's going to demonstrate, I think, the leverage we have to higher prices. So, such a large metal output production profile over such a long life. It's really the leverage here that our investors are in the game here for. About $250 million of NPV added for every $100 ounce per ounce increase in the palladium price. So we're really going to try and demonstrate that to the market. And really move into a feasibility study as well. So we've done the PFS now. We've really sort of reshaped and panel beat the project into shape. We've got the flow sheet. Now it's really just getting the engineering to a...
That's a fascinating equation. The link between the palladium price and the NPV of the project, which obviously then extends to some degree at least to the share price. So if we were to get a $500 an ounce increase in the palladium price, you would have to think the share price is going to go on a serious trot.
Yeah, well, I mean, we've seen the share price move very, very wildly in the past, really because there's very few ways to play a movement upwards in the palladium price. It is a highly leveraged asset, and it's one of the few assets of scale in the Western world, in a safe place to invest. So, yeah, it makes a lot of sense that our stock, moves upwards sharply with upwards movements in the palladium price. So, yeah, we think we're in a great position. We've got a project that works still at the bottom of the cycle, so we don't need those higher prices, but it certainly makes the returns look fairly eye-watering at these sorts of spot prices.
Well, you finished the year on a very high note, haven't you? I think the Ford announcement, the great reverse ferret by Ford there, the as you say, the EU announcement on as well, it shows that definitely you've got a couple of big tailwinds here going into 2026. So we'll watch this closely. Obviously, it's a direct link to the palladium price, among other things, and we'll have a chat in the new year.
Thanks, Paul. Great to be with you.
Thanks, Alex.
Cheers.
You've been listening to The Whole Truth, a Resources Rising Stars podcast, produced by Resource Media, hosted by Paul Armstrong for Reed Corporate. Please note that Reed Corporate does not provide investment advice, and investors should seek personalised advice before making any investment decisions.